Okay, so as I was just talking about the statement of cash flows, I was like, why do I need to learn the statement of cash flows? Well, it turned out that there is a good reason why we have to look at the statement of cash flows. Okay, for one, um, if you ever take a CFA test, especially in the second level, I think now getting into the level one as well, that the statement of cash flows gives us a lot of information about what kind of bad thing are the accountants doing. Haha. Why is that? Well, with the accounting accrual, with all the judgment call that you can pull off on where to put what and when to account for what, for cash flow, you cannot do that. Okay, so as messy as it is, you really cannot do much to it. It is what it is, and hopefully, if you're not really cheating, um, what does that mean? It means that over the time, the you see in the financial statements in other parts, I mean, net income, in the income statements and all the ratios you see, it should somehow reconcile of what you see in the cash flow statements. Does that make sense? Right. So I'm saying that over the time, over the time, the um, the net income or other profit measures should concur or reconcile or converge with the performance you see in cash flow. So if that is not the case, if the divergence gets bigger and bigger, what does that mean? There is something hidden in the table, under the table actually, that you really want to dig out. So you want to monitor not only the net income, profits, net the statements according to all the ratios that we care about, especially mentioned in the next chapter, chapter 3, not today, but also you need to look at the cash flows. You need to look at over the time, are they truthfully reverting to the cash flows? If they are talking about one time, two time, three time temporary stuff that's happening here, or they're doing the change of rules here that is going to hopefully, like all those CFOs says, will more truthfully reflect their operational status, then the cash flow should show that. Okay, so and that's exactly why we as financial people, we love to talk about the cash flow. And part of it is because a universal valuation of any security in the world is that you take the sum of the present value of all future cash flows that you can earn in a security. So eventually, all the opinions and concepts and forecasts and the potentials will count, but they should all translate eventually into cash flows because, we're talking about currency. Okay. So here's the statement of cash flow. And of course, the focus of all the focus is the operating activities. So the cash flow has the operation part, has the investment part, and has a financing part. So then all three parts added together, you should see it pretty much kind of the same value. Okay, so why is that? Well, every single period, the cash flow that you generate from one side should be equal to the cash flow that you use in the other side. Okay, so operating activities. Now here we are using a kind of what we call the indirect method, and we're trying to back out everything from the change in the net income. Okay, so and add on to the change of the net income 951336. Remember, we're having the net income. Oh yeah, not the change in net income. It should be the 2013 net income 95136. Sorry about that. Okay, then take on the adjustment of depreciation. Why adjust for depreciation? Right, Bao? Go ahead, Bao. Cannot hear you.
I'm saying we have to adjust it because it's not cash, so you can't really consider it as receiving cash or giving away cash.
Exactly. So basically, it is not really cash. It's kind of, remember, it's from some economic rationale that we hopefully was chopping over the difference between the current purchase price or the value of the asset and the disposable asset value over the years. So actually, for every single year, you're not really actually expensing or paying people for that depreciation, but just conceptually depreciating it. So anything that appears in the other statements that's not actually cash, we should reverse it. And anything that appears in other statements that are actually related to cash but not reflected, we should add it back. Okay, so now the depreciation is reversed. It was originally expensed. Now we add it back. So that's why it's a positive. For the accounts receivable and accounts inventories, the inventories, we need to have change in them. Why is that? Because these are including the accounts payable and account accruals. These are all balance sheet items, and the balance sheets are snapshots. Okay, so if you take just one snapshot, you don't know what will happen over the whole period. That's why we need to take two different snapshots, one at the beginning, one at the end, and we look at how things differ over the time. So that's why we see that the change in the accounts receivable, say conceptually, if the accounts receivable is increasing, what does that mean? It means that people are owing you more and more money, right? So if people are owing you more and more money, you are, in accounting accrual sense, you are recording more profit, but you haven't actually received it. So that you need to subtract from whatever accounting accrual numbers. And same kind of logic for inventory. For the inventory, if you see a change in the inventory, okay, so you're seeing the asset really accruing in your balance sheet. However, in fact, just by stacking up all those products, you are not getting any cash from anybody. So these things are not earned yet. And that's why if there is an increment in inventory, you will have to subtract it. Okay, change in accounts payable should be the reverse of changing accounts receivable. Namely, for accounts payable, you are owing more and more money to people, and that's the accounting sense expensed money, or like more liability that actually does not reflect in cash flow. So you should add back the part that you haven't really paid yet. And same story in accruals. Okay, so that you need to add back the stuff that you haven't really expensed. So after making all these adjustments, we get the net cash flow provided or used by the operations part. Okay, so that is some part that you actually used because it's a negative value. Investment activities, the cash used to acquire the fixed asset, well, yeah, it does. We do see people paying a lot of money to get more fixed asset, and the change in the short-term investment. So we are going to add back any of the positive change, right? Okay, so net cash flow provided by the investment activities is again a negative number. So financing activities, these are the stuff that we are actually raising. So if we have any increase in the notes payable, what does that mean? It means are we borrowing more money or lending more money? Yeah, we're borrowing more money, right? So in that sense, do you see more cash flow? Yeah, you do see more cash flow because you borrow more money. Things are coming your way. And changing the long-term debt, any positive increment for long-term debt also means more cash flow to you. So that is 676568. Okay, payment of cash dividend, of course, that is related to cash that you need to subtract. So the net cash provided used by the financial activity is this amount. Okay, so if you come back and see 1185568 and look at these two numbers, okay, they should reconcile with each other. So the summary of the statement of cash flow, you have cash flow by operations, this one, cash flow used to acquire fixed assets, this one, okay. Then you have the financing account, okay, net change in the cash flow, and the total is some small value that you actually are expensing out over the time. So cash at the beginning of the year should be 9,000. If it's 9,000, then at the end of the year, it should be less. It should be 1718 less than the beginning of the year. Okay, so that is how you really make sense of cash flow just in the first round. We all make sense of all the statements for many rounds. The cash flow, just look at operations, okay, investments in a sense of investing in fixed assets, and financing. So financing is where you get the money, and investment, the other two parts, are how you operate and generate things. Okay, and then in next chapter, we are going to look at lots of ratios and other things. And we're actually not going to tell you about all those accrual measures and how manipulative are those statements. If you're interested, I recommend that you look at the financial statement analysis course. Okay. Now, after we talk about all three statements, one thing that is very important to us is the free cash flow, as that's why it's the starting point of today's session, is because the free cash flow is what financial analysts actually rely on to evaluate a firm. One of the three biggest tools. Okay, so if you're evaluating a firm, you can look at the free cash flow to the firm, free cash flow to the equity, who are the equity holder, the shareholders. Okay, so you care about the free cash flow to the shareholders. You care about the firm value as a whole, so you care about the free cash flow to the firm. And you care about the dividend paid, so you care about all the models about the dividend discounted models. Okay, so as one of the three most important concepts, the free cash flow is not as straightforward as the cash flow statement should be, mainly because the free cash flow is kind of a financial economical kind of concept that you're not really looking at only cash flow. You're not really looking at the whole cash flow either. You're looking at kind of a part of the cash flow that is related to the operations part, and that is free for the managers to use. Okay, so free cash flow is the amount of cash available from operations, first of all, for, actually do that, operations, for distribution to all investors, okay, including stockholders and debt holders, after making the necessary investment to support the operations. So if you have more free cash flow, of course, everything works better, because now you have pretty much more resource at your hand to use. Either you want to reinvest in it, or you want to pay it out to stockholders, or you want to pay it back to the debt holders. Okay, so for a company, its value really depends on the amount of free cash flow it can generate. So that is the bottom line of what we are looking at. Well, a lot of people say bottom line is net income, but cash flow, free cash flow, is also very, very important. Okay, so how would you use free cash flow? Once you get the free cash flow, you could pay interest on debt. You could pay back principal on debt. These are paying back to the debt holders. And you could pay dividends. You could buy back stock. These are the ways to pay to equity holders, right? So you can buy non-operating assets, for example, securities and investments and other things. And we do need to monitor these different parts. And calculate free cash flow in 5 easy steps. And you look at this chart and say, you call that easy? Well, yeah, if we break it down into step by step, probably is not that horrible as it seems at once. So the concept, let's follow the whole idea. The step number 1, you are going to calculate the NOPAT. Okay. So step number 2, you're going to look at net operating working capital. Then you are going to use the net operating working capital to calculate the net operating capital. So working capital is short term, and added on to the long term, you get the total operating capital. Okay, so the total net operating capital, and you have to repeat the whole step 2 and 3 for the last year as well. So here, what's hidden step is step 2, step 3, repeat it for another time point. So then you get the total net operating capital for this year and last year. And the goal is to figure out the change of it. And the argument is that if there's any change in the net operating capital, it must be someone is investing in it. Okay, so we want to calculate the part that is invested in it so that we can take the net operating profit after tax minus the net operating investment in operating capital. Okay, so the stuff that you are able to generate minus the amount of investment you have to do to sustain your operations, and the rest of it is your free cash flow. Okay, the yellow one right here. Is everybody follow me? You okay? Cool. So then we are going to move on to step number 1. We are going to figure out what's generating from the operation. Okay, so net operating profit after tax. That's what we call the NOPAT. Next time you see NOPAT, yeah, it makes no sense. But once you expand it, kind of makes sense. So after taxes, you are going to have EBIT multiplied by 1 minus tax rate. Now, you're like, wait a minute, isn't that just net income? What's the difference between NOPAT and net income? Interest, exactly. Okay, so remember, in net income, we are going to pay out the interest. And then after that, we are going to dispense the tax. Now here, we did not pay out the interest, but directly expense kind of dispense the tax, but we are taking just 1 minus tax rate because the interest has a deduction in the tax. So I cannot say you are indirectly expensing the tax. In a sense, you'll be expensing more than a tax. So it's not an actual value that you will see, but it's more like an estimate. So the NOPAT, why do we want to keep the interest in it and take away the tax? People? Oh, dead silent. Oh, sorry. Okay. So why do we want to keep interest in the NOPAT measure? Wrong spelling. Get it? Because interest is not related to operating activities. Only operating income is accounted for. You paid out interest. You have to pay out the interest regardless. Why don't you just take it out here? I mean, it's not, well, isn't that the free cash flow should be something that is free to use to your discretion? Shouldn't we just take out interest? Okay, so let's come back and look at the definition. When in doubt, come back and look at the definition. And the free cash flow is the amount of cash available from operations for distribution to all investors. So here we're not talking about just the equity holders, including stockholders and debt holders. Now, does that make sense? We have to keep the interest payment in there because it's part of the payment we're distributing to the debt holders. Does that make sense? So, yeah, in a sense that we are looking at the NOPAT as a key measure for the operation before we even start to shovel out money to the debt holders. Even if most of the time the debt holders are going to take a fixed interest, but we still looking at some measure that's before that. Okay, so it's not part of the money you're able to use. You will have to pay it out. But remember, over the long run or medium term, you can still change your debt structure or financing structure. So you can kind of control how much money you are paying out in the interest rate, in the interest payment. So it's still partially up to their discretion, just not immediately. Does that make sense, Brock? Yeah. So whatever, this is the best or like the cleanest or the easiest kind of strike a balancing between easiest and the cleanest measure. So this is what everybody's using, the NOPAT, and remember that we take EBIT multiplied by 1 minus tax rate. So for that, we have done step number 1, and we are going to look at the operating current asset. Remember, the goal is to, where are we on the map? Okay, we've done step number 1, NOPAT. Now we're going to look at the current assets minus the current liabilities so we can get the working capital. Once we get the working capital, we plus the long-term asset and get the net operating capital, not working anymore, just total capital. And then we do that for this year. We do the whole thing for the last year. We see the difference. Okay, so step by step. Operating current assets. Okay, come back to the kind of partially the concept that we have nailed before. We are going to exclude the short-term investment from the current asset. Everybody agreed it's not really related to operations. Okay, and the operations is what we are focusing on here. We are going to take cash, inventory, and accounts receivables. And we are going to do the same thing for the current liability. Take only the accounts payable and accruals and exclude the notes payable because it's a source of financing, not a part of operations. Okay, once we do that, we take operating current asset, which is from cash, inventory, and accounts receivable, and we take operating current liability, which is the accounts payable and the accrual. Okay, so we take a total 5 different numbers, put it in there. That is what we call the net operating working capital. How do pronunciate that? NOWIC? I don't know. We just say net operating working capital. NOWC. How about that? Okay. So once we figure out NOWC, we add on the net fixed asset, and that's our operating capital. Not working anymore. Remember, working is the short term. Working is kind of, in a sense, the current. Okay, so then we have the total thing, and then we are going to do the operating capital in 2013 is this amount. Operating capital in 2012 is this amount. And assume that you are a supercomputer that you can automatically generate that whatever number you want in just 1 second. You get 1138600. Okay, now you're going to take the difference. You take the difference between the 2257632 and 113,600. That's your investment in operating capital. So you take this number and the difference between this number and this number. That's your investment. Okay. If you have a notepad, subtract your investment. This is your free cash flow. You're like, if you're investors, do you like it? No? Yeah, I mean, investors don't like negative numbers in general. Well, again, your free cash flow is not always meant to be positive. Remember, part of it is that it counts for the investment. Okay, so sometimes the investment could be good. So if it's just a couple of first years investment, you're paying out at first, and later on you're expecting a lot better profit, more positive free cash flow coming, that's good. That's actually not a bad story. That's usually the pattern that you're expecting. Is if you don't pay out any investment right now, you're not going to get any of the return in a later time point. So the key is not to just look at only one number. You'll have to look at the trend over the time. Okay, so if it's 1 or 2 big negative free cash flow and followed by a bunch of pretty healthy positive free cash flow, then it's good. If you see things go even worse and worse and worse and worse, then it's bad. Okay, that makes sense? And ideally, you can somehow keep it stable over the time, and ideally the free cash flow change should be kind of reconciled, kind of make sense, be consistent with what you see in the income statement. Okay. So how did they wind up using the free cash flow? Well, they have to pay out interest. They have to increase or reduce the debt. Okay, they have to pay out or reduce the debt. They have to pay dividend, and they have to purchase some kind of short-term investments. Okay, I know they are. This is highly leveraged, and that's exactly why when you see this, you're like, oh wow, the net operating, the NOPAT, it's so small compared to the net investment. And it's a huge number, huge investment that you're getting. Okay, so and here is another concept that I earlier mentioned. Okay, so these are one of the series of what we call the individual kind of economic sense measures. The first one is the return on invested capital, the ROIC, return on invested capital. So that will be the NOPAT, the stuff that you generate from operations as before before the distribution back to any source of capital, divided by the operating capital. Okay, so that is the return that you generate in all the invested capital, and this is for 13 is 0.5, and for 12 is 11. It's like, whoa, when you see that, are you guys happy? Go ahead and tell us.
What is the difference between ROIC 13 and ROIC 12?
Oh, I see. So this is ROIC 12 is what you see in year 2012, and ROIC 13 is the number you see in 2013. So basically, well, sorry, my fault. So basically, in 2012, they're having a return on invested capital 11%, but in 2013, it drops down to 0.5%. And that's why I say, whoa, that is no good. And people are probably not going to be happy to see that. Okay, so if the firm has cost of capital is 10%, as we all know that any kind of capital has a cost. If you're raising a fund, it has a cost. For example, for the bonds, if you're raising a debt, it's interest payment are the cost of that debt, right? So, well, if the cost of capital is 10%, then we compare the cost of capital to the return on invested capital. Ideally, a healthily profitable company who's properly managed, they should generate a return on the invested capital, ROIC, that is higher than its cost. And that's the only way you can make money, right? So if you generate the return higher than your cost of funding, then you can generate value over the time. Okay, so well, in this case, ROIC is 0.5. It's not even close. Okay, so the investors actually did not get the return they require. So, however, the next bullet point, we are trying to make a sense and say, okay, if the ROIC is greater than WACC weighted cost of capital, okay, it's okay, even if you have a negative free cash flow. But here, not only you have a negative free cash flow, but also you're not really getting the operational sense, because that you are not really getting your money's worth from the return. Does that make sense? Because the free cash flow has the operation part, the NOPAT, and the investment. If they are making the investment and say if they are making a huge investment and say, okay, that drop of free cash flow or the negative free cash flow is mainly from a huge investment, then you're like, okay, that is fine. Let's back up and carve out the investment part and look at only this NOPAT part, the operational part. Does that alone make sense for me to invest in you? And here in 2013, well, it's not the story anymore because the NOPAT is compared to its operating capital, the return that's generated from NOPAT is only 0.5%. So either way, you're not able to justify this kind of performance, right? Does that make sense, everyone? So here what we're trying to do is we look at the whole performance with a combination of NOPAT and the ROIC. With a combination of free cash flow and the ROIC. You know what? In this case, I should really do this. Okay. Okay. Look at the performance using the free cash flow, of course. Okay. However, a lot of times we need to look at the ROIC. Okay, so free cash flow. Is that positive? Is that a consistent stream? Okay, and for the ROIC, we want to look at it and compare it to, because this is the return you generate on capital, so you want to compare it to the cost of capital. So if the free cash flow itself is negative, that itself is not that bad if you can still justify using a higher ROIC than the cost of capital. However, if in this case the ROIC is 0.5%, and the cost of capital, the cost is 10%, plus a negative free cash flow. That means not only they are paying a lot as an investment, but also they are not doing very well in the operational part. So that kind of signals a lot more risk, if you will. Okay, so sharing this one, and I don't know, can I save this screen somehow? It's like every time I read it, there's no way. Is there any way I can save it? Oh, that's annoying. So people take a screenshot or write it down, because otherwise, once I start sharing the file, the board will be kind of just erased away. Okay, coming back to this slideshow. Okay. Okay, that is ROIC. Now we need to look at another concept called the economic value added. So what is economic value added? If we look at the net operating profit after tax. Okay, so pretty much all the things that you can generate through operations. Then if you look at how much is the dollar cents of the cost, okay, so remember the weighted average cost of capital, this WACC is a return or percentage sense, or return or like an interest rate. So these are like a rate kind of sense, percentage rate sense. But NOPAT itself is not in percentage. So we try to generate everything, we try to make everything into the dollar sense. So we take the percentage sense of WACC, multiply by the whole capital, and this whole thing is what we can argue that this is the dollar cost of capital. That makes sense. So with the dollar cost of capital, this is what we generate the return generated from capital. Operating capital. Okay, so the difference between them is the value really added in an economic sense. Okay, people like it? Does that make sense? Cool. I feel like we're getting silent for too long. Okay. So this is economic value added. So now if we are going to take WACC as 10%, don't ask me how we get the WACC. For now, we are just pulling numbers from the air. But towards the end of semester, we'll be able to precisely calculate that. Okay, so for WACC now it's given as 10% multiplied by the capital. Okay, where does this capital come from? 2257632. Where does the capital come from? Let's see, sharing files and this one. Okay, so oh, why am I jumping around? Do you remember what are those numbers, the capitals? Oh, I hate it when it jumps around. Okay, so this is working capital. Okay, operating capital. Remember these numbers: 2257632. In 2012, it is 1138600. This is the capital we are talking about. Okay, not the total asset that you see in the balance sheet. So we are arguing that these are the capital that they use in the operational part. So that's why we should use this capital multiplied by the WACC. Okay, and move it somehow to closer. Okay, so take that number, multiply by WACC. You are going to see the kind of a dollar cost of the capital. And then you use that, subtract from NOPAT, that's your value added. Okay, so how do I find this one? Okay, so NOPAT, kind of meager number in 2013, minus WACC, 10%, or alternatively 0.1, multiplied by the capital in that year, and you are going to get a negative economic value added. Okay, in 2012, things are much better because you have a much healthier NOPAT. And then again, minus the dollar cost of all your capital, you're going to get 11600. Okay, so with that in mind, it just every time I click on the slide, it just like to jump away from here and there. Okay, then market value added. So how many measures we have talked about so far? The NOPAT is the first one. Then we talk about how you get NOPAT from the how you get free cash flow from NOPAT, and then ROIC, how you combine to look at combine ROIC and the free cash flow to look at the situation. Then we come down and look at the economic value added. Now we're looking at the market value added. So previously we are not looking at the market price. And this time we're looking at the market price of the shares. So we look at the market value of the firm, which is the number of shares of stock multiplied by the price per share. Okay, it makes sense. Minus the book value of the firm. So what is the book value of the firm? Well, you're going to take the book value of the equity and book value of debt. Again, what is the book value? Well, the book value is simply the value you see on the balance sheet. Well, as we all know that the number that you see in the balance sheet is not necessarily the number you see in the market. For example, if according to the book value of equity, if you have a common equity divided by number of shares, that means per share common equity should be equal to $10. Doesn't mean that you always see $10 price in the market, right? Okay, so that's the difference between market value and the book value. So you're going to take, if you're going to take everything from the book, everything that's recorded in according to accounting sense, okay, and then look at the difference between the market value and the book value. What does that stand for? People have any idea? Come on, people. What does the market value added stand for?
Is it like the is it how the stock is viewed by people who are looking to buy it?
How the stocks are doing? Yeah. So okay. How much do you sell the company and the sell company's real worth? Okay, so Brock thinks that the book value reflects how much the firm is really worth, and the market value is how much you'll sell it for. Okay, so in that sense, you're thinking about the book value of the firm more like an intrinsic value, right? Right, Brock? Right. So if that is the case, there should be no consistent positive market value added. So basically, over the long run, say over 200 years, if you look at a certain firm, if the book value of the firm is equal to its intrinsic value, then the market value or the market price of it should just either go higher or lower, and kind of volatile, kind of a move around the intrinsic value. Okay. Here we say that there is a piece that the market is pricing that is not recorded in the book value. Okay, so the book value of the firm look at all the difference between its assets and its liabilities. Basically, everything they own minus everything they owe. That's the book value of the firm. But there's other things that is not included in there. Even if there are, even if you counting all the tangible and intangible assets in there, there are part of the market value that is not related to even the intangible assets. Basically, those are not assets. And what can it be? What kind of market value you see? Because market value is beyond the firm's assets. Exactly. So very nice, Kaylin. Where the company could go or grow in the future. So basically, yeah, the skills from management, CEO, yes, all those like things that you don't account in your book value. So basically, you're looking at either the future, the potential, okay, and of course, the things that cannot be divided or separated from that is market's opinion. So it's all about what people think and how people think about the company. Do people think that they will get a lot higher potential, right? Brand recognition. Well, here is another story, Nicholas. Brand recognition can be partially accounted for as an intangible asset. Like the brand name itself is a lot of times accounted for as an intangible asset that will be reevaluated every year as an intangible asset or like a goodwill. If its value has been impaired, then you will take an amortization, or it can be having a write down. But it can be a lot of times included in part of a book value already. So Tracy says most things simply based on investors' perceptions. How do I say this? You really, there's a difference between, it's based on that. Yeah, it's the investor's perception cannot be separated from this. So in other words, all these judgment calls are subjective. Okay, so are these subjective things or a perception or like a arbitrary? Not necessarily. Is those can have some material information as well. So Tracy, does that kind of answer your question? Okay, good. Yeah, so yeah, it is kind of inseparable from the investor's perception, but it's not necessarily totally from the air. So people can have pretty solid common sense about where things are going to go, but sometimes those common sense or common opinion or like consensus of the market can go wrong as well, and that's where you see all the huge bubbles and when it bursts. So that is the market value added. Okay, so pretty much a sum of everything that you see, what the market's perception, market's opinion, or the information related to the potential and the future. That is a forward-looking, and the book value of the firm is a backward-looking, so historical-looking. So market value added is the additional piece on top of that. Okay, so if the market value of the debt is close to the book value of debt, then market value of added is equal to the market value of equity minus the book value of equity. So namely, if you don't see any value added from the debt part, you can just reduce it into a total equity form. Okay, which is most of the time the case, because the debt value a lot of times is pretty well recorded according to the accounting rule. It doesn't fluctuate as much for the market value. So in this case, 2013 MV8 market value added is 10,000 times $6 per each. That's the market value. Book value is 557,632. So in 2013, the number is 42368. 2012, 186,232. So namely, the market value added also has been reduced. So in that year, in a sense, if you look at the market value added and the economic value added, in that year, the company has killed a lot of value. Okay, so let's look at an example in the book. Okay, let me dig out problems. Just one moment. We have 12. Okay, let's look at the homework problems. Courtesy from Nicholas. See that the problem, the easy problems 1 to 6, and there should be one more. How do I do this? And let's see. I should be able to share it. Share application. This one. Page number. I don't know page number actually. It's cropped out. Let me share it though. Yeah. Hide. Get it bigger. You see it? Kind of. Okay. Thank you, Nicholas. Let me just quickly confirm that this is exactly the one that we want to see. So 1 and 2. Oh, yes. Okay, good. So that is 2. That is 1. And let's look at question number 2. So corporate bonds issued by Johnson Corporation currently yields 8%. Okay. Municipal bonds of equal risk currently yield 6%. At what tax rate would an investor to be indifferent between two bonds? Okay, so that should be related to the next part actually. Let's skip that one for now until later when we finish our tax part. And let's look at question 4 first. And Talbot Enterprise recently reported an EBITDA. Okay, what are the DA? That's depreciation and amortization. It's more like operational, more operational than the EBIT. So they reported EBITDA of 8 million and net income of 2.4 million. Had 2 million of interest expense, and its corporate tax rate was 40%. What is its charge for depreciation and amortization? So can everyone come back to the net income statement and try to reconcile this one? Okay, so here we have EBITDA. So we need to somehow draw a line first. Okay, and EBITDA. EBITDA is 8 million. Okay. Now, after EBITDA, what should happen? Well, before that, we should have depreciation, right? And then we should have amortization. Okay. After those, we get EBIT. Okay. So then after EBIT, we have, sorry. After EBIT, we have the corporation, have the interest payment, and we have the tax. So then if it had 2 million of 2 million of interest expense and corporate tax is 40%, and net income is 2.4 million. Okay, so and tax rate is 40%. What is its charge for depreciation and amortization? So if we put this as a whole number, so here, instead of have them separate, and amortization, and take that. So we're asking about this number. Okay. So this is one number we are missing, two numbers we're missing, and three numbers we're missing. Okay, so we try to fill it out one by one. Okay, so if the tax is 40%, so it means after tax, the net income is 24. So that means that if we have an before tax, okay, EBT multiply by 1 minus 40% is equal to 2400,000, right? So the EPT should be equal to, people, exactly, very good. So EPT should be 4 million. Okay, so that's first mystery. So there should have another line here. Earnings before tax. Or let me move things a little bit. Oh, it's so hard to write on this. Come on. And it freezes on me. Oh, it's very nice of you. Bummer. Okay, so use your imagination. Okay. The following page has become unresponsive. You can wait for them to become responsive or kill them. Okay, give you a second chance. Now. Hello, people. I'm back. Can you hear me? Oh, good. Oh, gosh. I was gonna have a heart attack or something. Oh, okay. So now I think that his whole system hopefully will behave, and let's move on and add that damn little line here and move things around a little bit. Oh, no. That's not what I meant. Okay, good. Okay, good. Now move it down a little bit. And we have... Ah, oh, now it's killing me. I just erased everything. Yeah, I think that's a good timing. Okay, so after we take a 15 minutes break, I want you all to come back with the correct answer and put it in the chat room and make sure that I can see. Okay, so let's take a break. It's a good indication for a break. Gosh.